Welcome to Fear and Greed bonus interview. I'm Shaun Aylmer. After a very turbulent month, it's worth a closer look at the big miners. The outlook for BHP, Rio Tinto and Fortescue metals is tied by varying degrees to demand from China and iron ore. And China's been hit very hard by US tariffs. As always, this is general information only. You should always seek independent advice before making investment decisions. Shaun Weick is a senior investment analyst at Wilson Asset Management. Shaun, welcome to Fear and Greed.
Thanks very much for having me.
How do you characterise the big three miners? Been a tough period for them.
Yeah, no, it definitely has. I mean, the big miner share prices have declined around 12% over the past month with, Trump's obviously greater than expected tariffs causing, gyrations across global markets. So, from a relative standpoint, we've seen the miners materially underperform the broader market. They're down about, 4%. So, clearly showing their sensitivity to global growth. And as you mentioned, I think more importantly, concerns around the demand outlook for China.
When you think of the three of them, they're not actually that similar. I mean, they're all miners, but otherwise BHP is a long way from Rio, and they're both a very long way from Fortescue Metals Group. Which of them look best placed, I suppose, in terms of diversification?
Yeah, I mean, BHP is clearly, the most diversified out of the three. But, what you typically see in these bouts of excessive volatility, all correlations tend to go to one and the stocks get sort of indiscriminately sold off. So, the big miners do have very strong balance sheets, all three, and, they operate at the bottom of the cost curves globally. So I do think they're well positioned to weather the volatility, but clearly it will be dependent on sort of how some things around policy evolve from here.
What about China? What's the outlook for China?
Yeah, I mean, I think the outlook from here is heavily dependent on, obviously China and the developments around tariffs. Like there's various scenarios that could play out here and it could have, I suppose, significant ramifications for the US dollar and commodity demand. So I think as clarity on a trade deal emerges, China's likely to deploy stimulus at some point to support the economy. And if, you listen to some of the recent narrative coming out of US Treasury Scott Bessent around the three-legged stool, if that theory proves right and it's tariffs first, tax cuts, then deregulation, you could actually see a pretty sharp rebound in US growth. So I think it's important at the moment not to get too negative, as silly as that sounds.
It's easy to do.
Yeah.
Okay, so let's take them one by one. BHP, the most diversified of the lot, though it has in recent years earned a lot of money via iron ore. At the moment, cheap relative to recent years, Shaun?
Yeah, no, I'd completely agree with that. I mean, in anticipation of the tariffs, we have seen some commodity prices sort of overshoot to the upside as US buyers accumulated inventory. And as the world adjusts to the Trump tariff settings, we see, I suppose, some near-term potential for some commodities to overshoot to the downside. Our view is the risks there are probably greatest around copper and aluminium. So, yeah, from our perspective, you're probably looking towards the players that have the least exposure there. But, yeah, valuations have derated, and those that are sort of willing to look through the short-term, volatility, the longer-term price outlook's positive. I mean, you've got a lack of supply growth across most major commodities, and the demand drivers around US and European onshoring, investment in infrastructure and electrification are going to remain there. So, yeah, we think that they do look attractive from that standpoint.
Is there any one of the three that looks particularly good or otherwise?
Yeah, I mean, I think at the moment for us, we'd probably lean towards BHP.
Right, because the diversification story?
Yeah, clearly the diversification and I mean the balance sheets there is obviously very strong, and just where they're operating on the cost curves globally, we think they're well placed.
What about a company like BHP? There's lots of external noise around where it's going to list and whether it should have its primary listing in Australia. Unlikely to get across the line, that one. But what's the prospects for Rio, given how reliant it is on iron ore and it's got some big expenditure coming up?
Yeah, I mean, Rio, I think that's the key issue there is just what the CapEx profile sort of looks like. But, in terms of, how we're thinking about iron ore, I mean, some of the recent indicators are the China property market actually showing stabilization, or at least, very least less negative.
Mm-hmm.
So, if under the scenario where there's a trade deal struck that isn't, completely destructive to Chinese and global growth, and you start to see some recovery and improvement in that housing market. And, clearly China, I think, will look to stimulate once they've got some clarity around tariffs. The iron ore price could actually hang in there pretty well, we think. So, we're just sort of watching and waiting to see how things evolve. But, Rio, we think, if you can get more constructive on iron ore, then, it's definitely, a decent way to play. And obviously Fortescue's got the most leverage from that standpoint. So, we'd probably opt for Fortescue over Rio.
Shaun, thanks for your time.
Thanks very much.
That was Shaun Weick, Senior Investment Analyst at Wilson Asset Management. Remember to get your own independent advice before making investment decisions. This is the Fear and Greed bonus interview. I'm Shaun Aylmer. Enjoy your day.